Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today, yes, it's the man himself, the governor of the great state of Texas, Mr. Michael Becker. Michael, how are you?
Paul, just got back from the longest due diligence assignment of my life, so glad to be back on the show.
I noticed that every time I go to you, and you're always on that due diligence assignment for you and your crew over at SPI. You guys must be buying a ton of stuff these days.
It was a complicated assignment this time, but it's been busy into 2020 and pretty busy start 2021 and tax return hell right now. So just kind of trying to keep it all together, but happy to be on today and happy to talk to my longtime friend, our guest on the show.
That's great. Also joining us, the professor, the guy that has all the answers that we ask the questions to, James Eng. James, thanks for being on also.
Thanks for having me, Mike and Paul, joining the crew here today to talk with our friend Mike Hardage.
So we're going to talk to Mike Hardage. I think Mike is a very interesting guy, and he's going to be telling you real stories. And, we hear a lot of gumdrops and Bobby socks, all the things that people turn to multifamily on, but I really want to hear the real stories. And Mike Hardage is somebody that we've done a lot of business with in the past that I truly trust and I think is a good operator, investor in multifamily. So we're going to talk something about maybe challenges, the real challenges, and maybe overcoming those challenges to really help investors out. And so, Mike Hardage, thanks for joining us. I certainly do appreciate that.
Hey, guys. Thanks for having me. I am just amazed that I'm in the presence of such gurus and knowledge and experience and wisdom. All you guys have been my mentors. Certainly Brad Sumrock got me in the program, taught me a lot, and continues to do so. But you guys have really helped me along the way, and I'm indebted to you for sure.
Mike, this is going to just be a real flexible call, and you can talk a little bit about whatever you want to talk about. But perhaps we can talk about Port Arthur, your maybe a little challenge down in Port Arthur for you, maybe the state of the market in South Texas, and what investors are currently buying these days, yield versus rehab, and maybe talk about you investing in other folks' transactions and what you've learned about that. And maybe you can talk a little bit about signing or not signing on it as a KP on somebody else's transaction. So this is going to be a real flexible conversation, but I'm going to kick it over to James and Michael, and let's start the conversation with Mike Hardage.
Yeah, so Mike, maybe just to give people, we know you well, but give people sort of the 10,000 foot view, sort of when you started investing in multi, and then how many deals approximately have you done, just to give people a little context.
Yeah, sure. So I'm a retired tech guru, had a great career, hated leaving it a couple years ago, doing multifamily full time. Just in the run up to that, I had invested in various commercial real estate asset classes, probably 35 plus years. And you pick one, and I've, dipped my toe in it and made a little money, probably lost some money. And then I found multifamily probably 8 years ago, really focused on that. As an engineer, it made a lot of sense to me. Analytics, risk management, it's what I did my whole working life. So then I had the good fortune running into Brad Sumrock, and it's just been a tremendous benefit since then. I had done all the prior investments with no real guidance and no adult supervision and body returns. And, I made a significant investment in my education, and it's made a huge difference. So for the past 7 years, I've only done multifamily. I wear essentially four hats, certainly an active passive investor. Sounds a little strange. I'm certainly a deal sponsor syndicator. I also am a coach mentor for the Sumrock Multifamily Organization and real estate buyer broker agent in South Texas for the Sumrock Multifamily real estate business. So, yeah, that's my background. And I'm all in full time, deployed a lot of capital, and trying to help a lot of people get started in the business because I certainly had a few mentors help me get going in the business as well.
Could you ballpark sort of number of deals you've invested in, sort of how many have gone sort of full cycle, and then how many you're in now? Just roughly, I know the last deal we did, there was a lot of things on that SREO, but just ballpark for the crowd here.
Yeah, sure. So every time I get a loan from you guys, you make me update that thing. So as painful as it is. Yeah, so it's fairly recent numbers. So 3 deals in the pipeline now, 2 deal sponsor, 1 passive. That will make 58 deals for me, a little under 12,000 doors. 17 of those deals have gone full cycle, 14 of which I was a deal sponsor in. Well, actually, I take that back. I think it's 9 that I've been a deal sponsor in that have gone full cycle. So hopefully that gives you a little background. So we buy opportunistically. I partner with various folks, although just a few guys I've kind of narrowed in that we have done deals together, and we buy 2-3 deals a year. Maybe if we're lucky, we'll get a 4th one. So it's we buy when we can. We go long periods when we don't find anything, and then we'll find a couple here, 1 there. So again, it's all about being opportunistic.
So maybe let's pick one of those, and let's start with the roses, Paul, and give us maybe one of your more successful deals. You can be a more recent transaction, maybe one that you took full cycle, and sort of give us the sort of 30-second commercial on why that deal was successful.
Yeah, it's a great question. Everybody likes to talk about the winners. I guess my sort of halo is had a deal in the secondary market that was a unicorn, in that I got cold call from a broker who didn't know what he was doing, representing a seller who didn't know what they were doing. He bought a property way under market. The property flooded, Hurricane Harvey, believe it or not. We ended up making a ton of money on the insurance claim. And we sold it and quadrupled investor capital to the investors. I mean, the deal itself did a little bit better, but to the investors. Those are the ones we like to talk about. I've had some doubles, triples, and that one. And then, I had one that just was a nightmare. But I think when you talk to people as deal sponsors, they don't like to talk about their challenging deals. They want to talk about their winners, and I guess that's human nature. But I tend to talk to a lot of students I work with about what can go wrong. Not only deal sponsors, but also passive investors. So a lot of lessons learned the hard way when you have a challenging deal.
All right, I'll let Mike jump in here.
Yeah. Let's talk about that though, Mike. I know I kind of helped you out several years ago. I know you bought a deal in Mesquite. Maybe talk about that one, and then we can talk about the Port Arthur one, because I know we had several conversations personally about that kind of throughout the years along the journey that you took. But you bought a deal in Mesquite too. I think that's maybe kind of more down the fairway deal. Maybe talk about that and how that deal went before we get into Port Arthur.
Yeah, it's a great deal, good history. Right down the street from one of your properties,
Yep.
Investor in as well. Seems to be doing well. It's a good workforce housing market. Bought that deal with partner AJ Sharma. Went in there and did kind of a moderate upgrade. Had a great management company, Valiant, and it was just a classic middle of the fairway B property that we ended up selling for about $100,000 a door. At the time, it was one of the first properties in the Metroplex that I was aware of that, kind of that vintage was sold for $100 a door. So we think we did really well. Yeah, it just, things went well. Very, very little challenges, a little difficult dealing with the city and codes and things
difficult
like that. But
starts with that.
it
If
went
I remember,
well.
Mike, you had a seller that was out of the country. And so it turned out then the story turned out good, but the beginning of the story is a little sketchy if I remember the story right. You had the seller out of the country, and you had a guy's needed like an extra week or something, and he just raked you over the coals. I don't know if you maybe talked through that a little bit. Yeah,
that's a good point. Yeah, out of the country seller had a son-in-law who was doing the language translation, and the guy was just a real hardballer, and we essentially, ran over to the boundary line on the contract, running out of time, and he extracted some pain and extra dollars out of us there in the run up to closing. So you just never know. Just make sure your contract is well written and you have extensions and things like that to mitigate those kinds of risks.
So Port Arthur, you guys got it. Let's talk about that deal a little bit, because I know you had numerous challenges. It wasn't just one thing. It was like a comedy of many challenges, right? So maybe talk about kind of the setup of the deal, kind of how big was it, when did you buy it, et cetera, and then we can kind of start talking through some of the challenges along the way.
Yeah, it's definitely a learning experience that you could write a case study about it and things to take away from it. It started with me wanting to get in the deal. It was my first co-sponsorship. I did not get to know my partners. I liked that market, but I didn't study the actual submarket within that market. It's a coastal petroleum, petrochem play, tons of jobs everywhere. So, good occupancy, good rents, that kinds of thing. So, yeah, I mean, and we didn't know the management company. We didn't really get referrals, and so management company turns out to be a disaster. They were incompetent and basically operated the property, ran the ground and concealed it, lied about the financials, lied about occupancy, and then, so that's, fired the manager who had done a great job because of personal conflict. So a lot of that just kind of put the thing off on the wrong foot. Then, we struggled with getting the management company changed, finding a good management company, replace them. Right about that time, we got a hurricane, which took out half our revenue, half our units overnight in a widespread disaster, jobs, businesses closing. And then on top of that, the realization of the flood insurance. We were insured to the max. But the thing that was the risk that we couldn't mitigate is the deductible for the loss of rents for flood. It was $25,000 a building times 15 buildings. $375,000. My partners checked out on me. So I covered that $375 out of my pocket, plus other funds after that. A year later, before we got very far into construction, we had a fire with fatalities. Kids playing with fireworks, apparently, and took out a building and 29 units offline in addition to the tragedy. So, insurance claims, lawsuits, all that, big distraction. Then, finally we get the property back together, looming COVID, petrochem market collapse. Remember, oil futures went up there briefly. So, and then we'd gotten behind a little bit on our mortgage payments, but the, default interest was spooling up. The lender, quite frankly, saw a huge opportunity to take the property and just, take the equity which had built up. We put a bunch of money into very nice improvements. So,
Michael Becker, what is default interest for anybody who doesn't know?
Yeah, we get behind. They typically, if you look at your mortgage, if you have like a 5% interest rate, usually the default interest is your note rate plus something. So I don't know what it was in your case, Mike, but probably plus 6 or plus 8 on top of the note rate.
Yeah, it was close to $1 million is what it rolled up to. I mean, so it accumulates fast and it keeps accumulating till you totally catch up on your P&I. And we were making double payments at that point every month. So that's because we've gotten a revenue going again.
So that's the stick that the lender has, that if you get behind or you're not paying your payments on time, the default interest continues to accrue until you catch up. And that is a big stick. And as Mike said, it was $1 million that the lender.
Yep. So, Mike, too, if I remember, before we kind of continue the story, you guys assumed the mortgage when you bought the deal, and then your now former business partner got you guys tied in with a different mortgage brokerage shop, not all capital, and got you guys stuck in a CMBS loan. Is that right?
Yeah, that's right. We actually we entered with a bridge, and after a year rolled into that CMBS. So that's the other thing. Just be aware, CMBS rules are a little different from the agencies. There are lockboxes and they're slower to respond and they just don't operate, under the principles or the guardrails, if you will, of the agencies. And it was extremely challenging, very frustrating, very costly. I mean, if things go well, this whole Lockbox thing is be $800,000 a month just for an extra bank account to daily sweep of funds. It's stuff you just don't know about until you get into it. But
and Mike and James, can you talk a little bit about what a lockbox is? Because a lot of people have never heard that phrase before.
Yeah, I mean, sometimes bridge lenders and CMBS lenders will set up a lockbox, and essentially what it means is the money that is coming from your property is going to go into that lockbox first. And then as long as your property is hitting certain, let's say, debt service hurdles or cash on cash hurdles, then that's not a problem. The money gets swept into your account, maybe the same day, maybe the next day. But what happens is if you are not making payments, or if your debt service is below 1.0, let's say, all that money gets trapped and the lender has control of essentially all the money coming into your property. So it makes it very difficult to run the property. It makes it very difficult to get out of that spiral. So keep going, Mike. How did you resolve? So you had bad management company, hurricane, fire, and then what?
The plague.
Well, and then, trying to sell. And you guys helped me. We looked at the markets for other debt in the worst possible time, probably in my lifetime, for the credit markets. I mean, it was COVID and everybody was, there for a few weeks. Credit markets were essentially shut down. So, I was wanting to refinance because we were in lease up and we were not that far from stabilization at that point, in a property that had more, almost 2/3 of the units upgraded. So we put a lot of insurance capital into the property. So to make a longer story short, just decided to go to market. So we couldn't do a full market cycle, but I called 4 or 5 of my broker friends, the high profile guys in Texas. We saw a bunch of offers, and we got one that we could live with that would get all the investor capital back. That was my first goal. And then I had loaned the deal close to $500,000, and on top of the original $400,000 equity that I had invested from the beginning. And I got almost all my money back. So it was a blessing in the end. And I'm sure the buyer is going to do very well with the property. All he has to do is, finish some upgrades and stabilize it. And there was a lot of equity.
What lessons did you learn on that? What you wouldn't do again?
Yeah, it's kind of my, when I work with students, here are the top few things. And I know Michael Becker's got his own, and I can, but, just know your partners, research the submarket very well. I mean, we knew it was a little risky. It was a kind of a high risk, high reward kind of underwriting deal, but know your submarkets. Make sure you know your management company. And as a passive investor in a deal like that, always invest in deals where your deal sponsor has the net worth to bridge a property out of their pocket, rather than first sign of trouble, you get a cash call email. You don't want that. I was on the other side of cash calls in other commercial real estate, non-multifamily in prior years, and it's an unpleasant experience. And I never want to, do that for my investors. So I think those are the key things.
Yeah, a lot of people have not gone through that with a cash call. And you said that you lent the property X amount of dollars to keep it going for the insurance piece. How difficult was that conversation with the investors out of your mouth, and how come they didn't step up with money?
I didn't ask. I was full disclosure, and I'm sure monthly updates. I'm sure people got sick of hearing this saga, ongoing saga. But no, I never asked for cash call, and that was not my intent. I was not going to. I was, did all kinds of things to avoid that. And the most straightforward thing is just to write checks, and I did that. And I hope I never have to do it again, and probably won't. But as the famous Michael Becker said, if you do enough deals, you're gonna have trouble. You're gonna get sued. There'll be a fire. There might be a shooting. All these things. So by the way, we had a shooting. Nobody got hit, but that was just a minor distraction to the story. So
But I think to your credit, I mean, if I was, which I wasn't, but if I was a passive investor in that deal and you stood up tall like you did, and you said you got everyone's money back at the end of the day.
I did, yeah.
That's a testament to like all the hard work, and I'm sure you lost, I don't know how many nights of sleep along the way trying to figure out how the hell you get out of this bind. And I think a lot of those lessons really just kind of like, I mean, it's been really tempting, not so much like today, but 1 to 3 years ago, these bridge debt funds were out there left and right. And they're kind of like loan to own is kind of what I think almost like Shylock money in a lot of ways, where, they'll give you higher leverage and they'll give you, somewhat of a decent rate because the rates came in, but it's Lockbox. It's, the carve outs are a little bit less favorable compared to like an agency loan. And then at the end of the day, it's kind of loan to own. So the first little hiccup, they're going to look to get you in default, put that default interest on you and try to pressure you to take the property back. And if you're invested with a sponsor that didn't have, some resources like you do, or there's kind of the intestinal fortitude to stick through this, I mean, the end of that story could have been a complete loss for all your investors along the way many years ago. So trying to make sure you understand what type of loan you're in, plus that loan you had defeasance on it on top of it. So you had default interest plus defeasance to deal with too. Is that right?
Oh, absolutely. And, were it not for those things, it would have been, an okay return for the investors. But the fees and the defeasance and everything just ate everything up. But yeah, to your point, deal sponsors, sometimes shop every loan possible choice out there, trying to chase a little bit of extra, underwritten return, and don't do that. Don't go into a loan product that clearly is not as good, maybe as an agency. Agency's not the solution for every deal, but just don't go out on a limb, chasing a little bit of extra return for your investors. It's not worth it. I mean,
yeah, that Lockbox
do that. I don't think at the time, but I see it. People looking at that, and I tell them, don't do it. It's not worth it.
Yeah, that Lockbox will be a real anchor around your neck, and just kind of just comes out of nowhere right at the worst time when you need your cash. They take all your cash away. So that's just been something that's been like a principle of mine that we just simply just won't do. And now I'm starting to get more and more allergic to yield maintenance or defeasance after fortunately I've never had this type of issue, but we certainly left tens and tens of millions of dollars on the table collectively because of yield maintenance or defeasance. So, making sure that we're structuring the right type of loan with it. And one of the things that's always kind of kept me up at night, which is why I have not gone to your backyard, Mike, in Houston, is just kind of the risk of, Houston's got the flood, the coastal markets have the hurricanes and the floods, and you can have, 9, over a 10-year period, 9 of them can be great. And then that hurricane comes through and that 1 year will wipe out many, many years of profitability, especially if you have high deductibles, like you said, on your flood insurance for loss of rents. And it takes you a year and you got to sue your insurance company and all those kind of things that are really hard to quantify when you're underwriting a deal. But those could be, a little bit more challenging along the way. So if you're in Houston, maybe be a little bit north or a little bit, I guess, west into town. Or if you're right on the bay, that's a lot higher risk.
Yeah. Coastal property, just watch out, because it's not a matter of if, it's when. But also just keep in mind, as an agent, a buyer broker agent, I get buyers from, all over the country and even out of the country. And Houston floods. Well, 6% of the apartments flooded in 2017 Hurricane Harvey. That was, once in a multiple lifetime event. A lot of the flooding was due to release of water from a couple of dams and reservoirs. And Houston has been studied more about flooding than any other city in the world, except maybe Venice, Italy. And there are maps. You can go in literally 30 seconds, look at how close the worst flood ever came to your property. So it's still straightforward to buy here. But yeah, I mean, the closer you are to the coast, the higher the winds and the greater the risk. Most of Houston is, 40, 50 miles from the actual coast. And, the wind from the hurricane is not going to get you. Local creeks and bayous flooding can, and you just avoid those. And they're mapped out really well. So it's easy to characterize those things.
I think that goes back to your local knowledge, and Houston's a completely different animal than Dallas. So you got to deal with that. So if you don't know what you need to know, you can buy in the wrong location, and then Houston's the largest city in the country that has no zoning laws, the city itself. So kind of understanding, where Dallas or Austin or, many markets across the country, you generally have the good parts of town and the bad parts of town, where Houston's kind of more street by street or block by block. And without that local knowledge, I think you get yourself likely to get yourself in a little bit more trouble than you would say like in Dallas or, one of these other markets across the country. So anyways, James, you want to take it over?
Yeah, Mike, maybe we'll talk. Let's talk about a recent transaction that you guys just closed in the fourth quarter. I want to talk about it in two ways. One, just sort of how you decided on the debt piece of the deal. So this I want to talk about Wooded Creek and how you guys sort of did the debt on that deal, and then sort of what your role was on that transaction. Because I think a lot of people, I like to call it sort of pieces of the puzzle or pieces of the deal, really like balance sheet, multifamily experience, ability to find the deal, raising equity. You have all those pieces, but you sort of were one of maybe 3 or 4 general partners on this deal. And so talk about that specific deal, sort of how that deal came about, what your role was, and then we can maybe talk about the debt on that deal as well.
Yeah, sure. So the key partner in that deal is Dustin LePac. He's also a friend and a Brad Simrock coach mentor, and he's the sort of Central Texas buyer broker agent for the Simrock Realty. So we work together daily and had always talked about trying to find a deal together. So he found that deal and essentially invited me in, to help with the capital raise and maybe to help with, getting the deal awarded to us because, it's a very, very competitive deal. That was a Madera-owned property. So again, the risk at entry was pretty low. Those guys are great operators. So we knew what we were getting into. And then on the debt side, you guys just made it really easy for us and laid out the options in that Freddie floating product with 1 point exit fee just made all the sense in the world. And we did not self-inflict any brain damage on that one. It was very straightforward, and appreciate you guys just really bringing it to our attention. And I waved the flag, wherever it makes sense. May not make sense in every deal. The yield maintenance is out there, but if you're of a mind, to hold the property 6, 7, 8 years, maybe it's not as detrimental. But if you want that flexibility, maybe 3, 4, 5 years to exit a deal, then there's no greater option that I'm aware of than what you guys brought to us with the Freddie floater.
Yeah, on that Freddie floater, I think we were able to get pretty close to 80% on it with like 4 years interest only, and then you had a 1% prepay. And your first month, I think your interest rate's probably 2.8, 2.9, something like that, and it'll just sort of sit there. And we're not expecting SOFR to really move. And then you guys bought a pretty low cap as well, so you're set up to do well on that deal and sort of not have a maturity, and you have the flexibility to exit, which is nice. So I guess when people are looking, a lot of the people who listen to the podcast, they might be trying to get their first deal done, maybe in their first, second deal. How do they sort of bring value to you, right? To somebody who already has the experience, the balance sheet, how do they stand out to you? Because there might be 50 people who want to partner with you, but I'm sure you say no more than you say yes. So how does someone stand out as a sort of beginner investor, bringing you a deal, right?
Right. No, it's interesting. I have that conversation multiple times a day, virtually every day, because, the Simrock organization, a lot of members and a lot of folks are getting involved, and it's just a great ecosystem. I tell, newer folks that, look, people come and they say they're smart and they'll work hard and they'll do all the work. And all they need is an experienced sponsor to get the deal awarded and get the agency loan. And I thank them for that. But everybody's smart and everybody works hard, right? No, I think, just being able to bring outside equity investors is a huge plus. Fundraising is a big time burner. Requires a lot of time to get one of these deals landed and get it to closing. But Yeah, I think people that are full-time, serious, have some key ingredients that make them, maybe they're a real estate professional already, or maybe they've got a portfolio of single-family homes. Just those kinds of things, I think, are important. And you have to get to know people. Is this somebody you want to start a business with? I mean, I think we see a lot of people partnering without getting to know partners, and I just cited my example where that's a huge mistake. Would you go out and even buy a Subway sandwich franchise without knowing who you're going to buy? And of course you wouldn't. You get to know them, spend time with them. And I think that's very important. Know your partner, top of the list again, and, words to live by in multifamily world. So for me, it's all those things plus, can you bring capital? That really, I think, would help me. And I think most experienced deal sponsors would say that. But if someone brings a deal that I was not aware of, which is pretty unusual, at least in the markets where I look, then, I'd have to take a second look and, is it worth giving them a bootstrap and getting them going because they find a deal? And I've done that before, and ended up, having good experiences with people I've, become friends with and done other deals with as well. And just one other thing before I forget. It's funny, you mentioned the Wooded Creek and the hurricanes. And so my painfully learned experience with 3 flooded properties in that hurricane I mentioned. So I learned a lot about floods and hurricanes and things, but that property was actually in the floodplain in DeSoto. It's never flooded. We talked to the city. It's never flooded. It was a FEMA design floodway. So there's a creek next to the property, and some of the buildings were in the flood zone. And I said, that's ridiculous. That's not supposed to be in the flood zone because of the definition of the floodway. So I know a firm that gets FEMA to reclassify properties in those situations. We got it reclassed out of the flood zone. So it saved on insurance. And, it will be a nice thing to have on the back end when we sell that property in a few years.
So the inexperienced person needs to bring either a deal or the ability to raise equity and bring that to you so that you can take a look at it and then potentially partner with that person if you like them. The short answer.
Well, maybe not. Maybe that's what I said. It's not certainly intended to be that way. But it's all about time, right? I mean, we're all just maxed out, flat out in this business, and it's a great thing. But and I really do like to help people, and I've helped people for less in this business. At least I think I have. And it's not altruism. I mean, maybe every now and then something will come back to me, but it's also not a quid pro quo. I mean, you guys have helped me immensely, and I know you've helped tons of people as well in this business. And that's why it's who you are and why you're held in so high regard. So if you give back a little bit, I think it's a good thing.
Mike, maybe you're in a lot of deals. Talk about sort of the impact of COVID to your properties, and then sort of maybe on operations piece, but then also in terms of deal volume and, sort of on the broker side, how people are looking at deals right now, sort of post-COVID.
Yeah, that's a great question. We've been very fortunate. We had one property ran a little thin on occupancy and collections. It's been corrected. I would not have predicted that these properties are doing this well in spite of COVID. Would they be doing better if everybody was paying rent? Yeah, it'd be doing a lot better. But some of the properties are showing record collections, and others could do better. But we just don't have any in trouble or even close to being in trouble because of COVID. Although I realize if you own in the wrong market, if you're on the West Coast or in parts of the Northeast, those guys are in trouble, and it's too bad. In terms of, the business and deals and things like that, clearly, 2020, there was a big, halt in deals and transactions there for a few months in the spring, and into the summer, it started heating, spooling back up, but now seems to be flat out. A lot of deals out there have come out, usually always in second half of January, deals, come back on the market, and we're seeing that. And, prices are just competitive as ever. I think seems like there are some opportunities in some markets like Houston. It seems like there's a little bit of maybe some of the institutional guys are kind of on the sideline in some markets, and it's presenting some opportunities, some long-term opportunities. I think with Houston being projected as number one job in population growth by Moody's and several other analytics firms, and what appears to be a 2022 very light on new development, bringing new units online. I think there's going to be some really good opportunities here and a lot of more. I mean, Dallas, Fort Worth is just, it's on fire. Still, for first or second best place to buy a multifamily, in my opinion, in the country.
So
Mike, I'm telling people to watch, just to close that thought out. I'm telling people, take a look at delinquency reports. Used to, we never did that, but now they're very important because those are little time bombs that are building and ticking. And when those people who owe you all that money start to move out, that's a direct hit on your NOI. Whereas now it's a balance sheet thing. It's kind of out of sight, out of mind. So that's really, I think, the one change that I think, COVID has brought on.
Yeah, to recap that too, I think it's an important point. What Mike just said was people that are living in your units, that are physically there, they owe you $1,000 a month in rent, but not paying you. That is hitting your income statement now, and it's not actually collecting the cash, so it's accruing as a receivable on your balance sheet. So when they actually, you actually have the ability to evict them, or they skip, or whenever they actually leave, if they've accrued, 5 months of $1,000 rent, you're gonna have a $5,000 bad debt write-off that hits your balance sheet. So I think whenever this actually kind of resolves itself, at some point in time, you're going to see a heck of a lot of bad debt hit everyone's income statement across the entire country. Really, that is not there. And James and Paul can talk to it more than probably Mike and I can. But the lenders are really digging into that. Fannie and Freddie are really digging into your delinquencies right now as they're doing these new deals and putting the COVID escrows in. So that is certainly something to keep an eye on. So Mike, you're pretty active in Houston, and I'm not. I'm active in Austin and Dallas, and so I've been, actively looking for a partner of ours that has a 1031 right now. We're trying to go out in place, and as crazy as these words sound about to come out of my mouth, I'm talking with some of these brokers, and I talked to a broker last week, and he's like, my new cap rate for Austin's like 3.5. And I was talking with a broker in Dallas, one of the most prominent guys in town. And he's like, it's hard to get something, starting with the 4 anymore in Dallas. And so I haven't quite seen that fully translate. And every deal is a little different. And, the submarkets are different. Some vintage are different. So I'm not going to take that as a blanket. But that's certainly the trend of where the cap rates are going. And, we kind of talked, previously I talked to Nick Flewellen I interviewed him not too long ago, in 2020. And, it didn't seem like cap rates had moved or pricing hadn't moved too much, but the interest rates were, certainly had come in with COVID. So we all anticipated the cap rates were going to compress. And so that's what it feels like is real time happening as we record this, that cap rates have just shifted 25 to 50 bips down in real time in the two markets I look at. Are you seeing that in Houston right now when you're pretty active for yourself and other clients?
Yeah, I think we are in certain submarkets. Yeah, the better quality submarkets. That's definitely the case. I'm buying a deal there now, and another. It's a great property, a little newer than we typically buy, but again, it's another example of what I was referring to earlier. I think normally it's kind of a small institutional property, typical buyer, and we got a chance to get in there. We had a good relationship with the listing brokers, and so we were able to get that one. But yeah. No doubt about it. I mean, it'll look, all your comments will reflect in that cap rate curve we see, looking back right now in real time, though, it just does look like deals are, trading, they continue to go up. And, but I think we all need to be careful to buy quality submarkets. Don't overpay for stuff that's marginal.
What are good submarkets in Houston?
That's a great question. I mean, there's big swaths in the north side and the west side. And then, around Midtown, that's institutional A-class, fairly newer stuff. But, north side, west side, there's a lot of great workforce housing on the east side. It's a little bit of a petrochem play. And, there's, some political pressure on fossil fuels. But a lot of talk, and eventually there's going to be shifts, but I think they'll be slow. Otherwise, we'll be walking to work if they try to put the story ahead of the reality. So, yeah, good strong markets, and with the backdrop of what I laid out earlier, with continued number one population growth, and maybe not that many new units coming online, we're bullish on Houston for sure.
So I think it's probably the greater Texas thing. So I just actually saw an article by our friend Greg Willett that came out that we just finished in 2020. So in the 11 years from 2010 through the full year of 2020, and in Dallas-Fort Worth, they absorbed or had more occupied units. So about 201,000 more units were occupied in the 11-year period than started. So that's kind of, as he pointed out, that's more than all the market, all the units in a city like Las Vegas, Charlotte, or San Antonio. So that's a pretty amazing stat, and that kind of encapsulates, Texas and the greater Texas and Houston and San Antonio and Austin, and the secondary markets are all getting it. And I know Mike's in many deals in many different markets. So, Mike, I appreciate you coming on. I'll kick it over to Paul to wrap up. But what I kind of really took away was, when you're invested in these deals, I mean, not every deal is going to go perfectly. I mean, obviously you talked when we started about having the four bagger, which we all love the four baggers. And you have the deal that had, every, flood, famine, shooting, fires, everything that could go wrong, aggressive lender, lock boxes, all those things. And in spite of that, your efforts, the investors benefited by you having some capital that kind of floated along the way. And then obviously you had a lot of stick-to-itiveness to fight through all these challenges and not give up, and got their money back. And that's honestly probably the best return they could ever have expected in a deal like that. And, if I was an investor in that deal and I saw you stand tall like that over a 4 or 5 year period like you did, I would have a lot of confidence in you and trust that, it's easy when these deals go great and the market's going up. But, really, I think that separates the better sponsors from the lesser ones, or the ones that the challenging times and challenging situations along the way. Because, every projection I've ever done has always been wrong, right? You either do better or you do worse. You never do exactly what you think you're going to do. And that's very true. So I commend you for standing tall, and I commend you coming on our show and talking about some of the lessons learned and some of the challenges and mistakes you made along the way. So I'll throw it over to Paul.
Mike, some great conversation. And let me just make sure I define a little bit about who you are, because I think that's important for people to know. Are you really, you're a sponsor of deals, but are you an operator of deals too? Are you looking at the day-to-day managing these properties as an asset manager specifically on each deal? Define a little bit about, again, what your role is these days.
Yeah.
What's changed from the Port Arthur deal?
Yeah, I was asset manager for almost every deal I got in for the first few years. Mm-hmm. And although, look, if my name's on the loan, if I bring investor capital, I'm on every conference call. I look at every report. I talk to every key contractor. I talk to the management company. I go to the property and visit the property. So even though I may not be the key asset manager, I'm involved. And the Houston deal, I will be the key asset manager. So that'll be the first one I've done in a little while. I'm happy to do it, but if I have a partner I can trust who's responsible for day-to-day asset management, then I just support that partner or partners. And I think it's a great model. But those people who get in deals and sign on loans and never read an email or go to the property, it's not a matter of if, it's when it's going to happen. They're going to get in trouble. And I just think that's the wrong thing to do for everybody involved, mostly the investors.
You started off talking a little bit about the Sumrock program that you're part of. Tell me a little bit about the impact that Sumrock program has done for you personally, with the knowledge that you've gained. And again, what role are you playing within that Sumrock ecosystem?
Yeah, Brad Sumrock is just an amazing guy. We're both ex-engineers. Work brought him to Houston, so he knows the Houston market really well, and he ended up in Dallas last several years. As I said, for 30-something years, I had invested in all kinds of real estate, commercial, single-family, residential, office, warehouse, all those things, strip centers. And I was learning on my own money, and that's, learning the hard way, learning by mistakes. And then I was blessed in my career to get some wins. I worked for startups. And when we would sell a startup or have an IPO, then, you get a payday, you get a big paycheck. So I was looking for something to get off the airplane that I could continue to be active in, but with some schedule flexibility. I wouldn't have to fly around every day or every week. And multifamily just resonated really well. So I had the good fortune to meet Brad, and I had just followed, his teaching very closely. And after a while, he invited me to be a coach mentor in his organization. Then he formed his real estate agency, buyer broker agency, for some of our members. And I became an agent in Houston here. So again, 4 hats for the Simrock organization: passive investor, active investor, mentor, coach, and a real estate agent. There are it's funny, in the 7 years I've been doing this for Brad, I should say, I cannot believe there's so many gurus and mentors that popped up out of nowhere. They did a deal and now they're a guru and they got a podcast and so it's pretty funny. A few guys that I've brought into, gotten them into their first deal are on the podcast circuit and got their own things going. And I'm proud of them to see that. But Simrock is good because it's a full ecosystem of knowledge, experience, education, large group, investor pools, shared best practices. It's been fantastic for me, and I'm trying to give back and support the company as best I can.
And then, Mike, if somebody wanted to reach out to you and just maybe ask you a question, are you open to that? And what would be the best way for them to contact you?
Yeah, surely. I spend a lot of time doing that very thing. The easiest thing to remember is Mike at bradsimrock.com. There's no C in Simrock, SUMROK. Mike at bradsimrock.com.
All right. James, finish us off on just final comments or things for Mike Hardage.
No, Mike, I appreciate you coming on. I mean, I think you shared some great lessons of how a general partner should act in these roles, and then good lessons for limited partners as well, because when they're making that investment, making sure that general partner can step up on a deal if there are any challenges. And I think there's been some deals definitely in the last 12 months where general partners have looked at each other and they couldn't rub 2 nickels together. And all of a sudden they went into forbearance, and then all of a sudden they needed to pay that money back in the last 2 or 3 months, and they couldn't catch up the payments the way you had to catch up payments on your deal. And so I appreciate you sharing that story and making sure people are sort of eyes wide open when they go into these deals. And thanks a lot for just, your support throughout the process. We've worked on numerous loans with you and your various team members. So we appreciate that as well.
So Mike Hardage,
Sure.
Mike Hardage, thanks for your honesty and your opinions. And I know that a lot of people will find a tremendous amount of value in the things that you say, and your actions have helped numerous investors in their partnerships to achieve financial freedom at some period of time. So Mike Hardage, thank you for being on. We certainly do appreciate that. James Zeng, thank you for hanging out with us. And Michael Becker, always a pleasure. Get back to one of your due diligence assignments.
Yeah, see you in a few months.
Yeah. All right. I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.